Okay, thank you, everyone. I think we will begin the session now. So first and foremost, just to say, Excellencies, friends, ladies and gentlemen, good afternoon. I would like to extend a very warm welcome to all of you in the room. And I believe there might be colleagues online who are also dining into this session on the theme, de-risking climate adaptation and resilient investments. My name is Ekoswehi Iyahen. I'm the Secretary General of the Insurance Development Forum, and I have the enviable task this evening of chairing this session, which is jointly being hosted by AFD as well as UNEP-FI. We've off to a late start, so bear with us if we're a little bit over time, but I can promise you it will not be too much over time. It's also a pleasure to see quite a few familiar faces in the room who have been around this topic for some time. As reflected in the session title, the focus is on de-risking climate adaptation and resilient investments with a view towards exploring how public development banks and private financial actors, including insurers, reinsurers, can better collaborate on this agenda. We have a fantastic group of leaders who will share their insights and experience, so I really want to appreciate their presence in terms of contributing to the dialogue that we are going to be having this afternoon. Just to set some ground rules, in terms of the structure of the session, we will have first and foremost a keynote to help frame the discussion. This will then be followed by 2 rounds of conversations across the table. The first will focus on public assets protection, followed by another session focused on credit default protection and solutions that are emerging. This will then be followed by an opportunity for question and answers and a rapid round of final reflections from our participants around the table. So before we get into it, I want to ask all speakers to please stick to the allotted time in order to ensure that we give everyone a fair opportunity for their contribution, and we can also bring these proceedings to a conclusion in reasonable time. And so with that, I would like to welcome Leslie Masdorp, who's the CEO of the British International Investment, to deliver the keynote to help us frame the discussion this afternoon. Thank you, Leslie.
Thank you very much, Madam Chair, and thank you very much for the invitation to be here. My name is Leslie Masdorp, and I'm the new Chief Executive of British International Investment, and it's therefore a great pleasure for me to be asked to make a few scene-setting remarks. The backdrop for Finance in Common, as we all know, one of the core rationale and drivers why Finance in Common was in fact established was to ensure that we can deepen and sharpen the coordination and collaboration amongst our institutions. So the first point I'd like to make is that we are specifically as BII very proud to be a founder and a funder of ARIC. So in that context, I would like to kick off by saying that we are committed to advance the adaptation and resilience agenda. As we all know, for a good number of, probably for the last decade, when people think of climate finance, the climate mitigation part is usually what comes first to mind, and in general, adaptation has become the sort of stepchild in the climate finance debate. As BII, we are very committed to ensure that we give much greater prominence to the adaptation and resilience agenda. The second point I'd like to make is that BII, as part of our initiative to have co-founded ARIC, is prioritizing investment in adaptation and resilience. And our approach is really informed by a 2-pronged strategy. The first part is to what we call invest to adapt. And what that means is really us working with our investee companies to address the physical risk that they are facing. This is particularly important in the context of infrastructure assets, which we all know are sort of long-dated, long-tenor assets, and because of the cascading impact of the failure to adapt, the damage that would cause. The second component of our 2-pronged strategy is really to invest in companies that offer adaptation and resilience solutions. And here we're talking about companies that enable people and businesses to adapt and to become more resilient against climate shocks. I'll just give 1 or 2 very brief examples of that. In terms of investing to adapt, we have a project with Zephyr Power in Pakistan, where we supported the implementation of mangrove protection and rehabilitation program to protect Zephyr Power, which is a 50 megawatt wind farm infrastructure project, and to protect that wind farm against sea level rise and coastal location. This intervention could save 20 times the value of the investment and $1 million in maintenance cost over the 25-year asset lifetime. At the same time, it benefits local communities, creating jobs for local fishermen and so on. Second example I'd like to make of companies we're investing that are offering adaptation and resilience solutions. The first one is us investing in a fund with Blue Orchard. It's called the Blue Orchard Insure Resilience Fund 2. We invested in this fund to improve the availability and access to climate insurance to the most poor and vulnerable. BII has a general strategy of both investing in direct companies for a development impact, but also investing in funds, and this is a good example of that. The final point I'd like to make, Madam Chair, is the importance of utilizing and making sure that we have sufficient concessional capital available and technical assistance in particular. These two are very important parts of the overall toolkit for development finance. And in particular, within the adaptation and resilience space, without the necessary concessional facilities, we would not be able to advance a lot of our work. And here I want to draw particular reference to the work of the Climate Innovation Facility, which is a 240 million pound pool of concessional capital provided by our shareholder, and it's enabling us to test, seed, and scale cutting-edge technologies, businesses, and investment strategies. So I want to just end off by saying that as BII, we committed to increase the pools of available technical assistance because as we are seeking solutions, we need to test and scale new ideas. And it is only if we have the necessary resources that are not necessarily yet ready for commercial application, we need those pools of finance. I'll pause there. Thank you very much for having me.
Thank you, Leslie, for those, I think, very concise and very clear framing remarks. Again, I think it was an elegant carryover for some of the themes that we heard at the high-level panel in terms of, you know, it's the role of concessional capital, the focus on adaptation and the resilience agenda, but also the very practical examples that you pointed to in terms of driving and supporting innovation in this space. So really appreciate your reflections. With that, I would like to now open the first panel. As I mentioned, we have a fantastic lineup of speakers to contribute some reflections on this theme. The speakers being Anthony Hobley, who is the Deputy CEO of Climate and Resilience at Howden. We also have Karina Wally, who is Sector Head, AXA Climate. Madeline Ronquest, Head Environmental Nature Risk, Climate First RAND, and Paolo Lombardo, Head International Cooperation and Development Finance Department at Cassa Depositi e Prestiti. So thank you all again for making the time to be here. So I'll start off with Anthony. Perhaps it is good that you're going first as a representative from the insurance industry, albeit more on the broker side. We started the conversation in the main hall with a request to a raise of hands about how many people from the industry were in the room, and I think it was perhaps only 2 hands. So it would be good, obviously, to hear your perspectives. Many of us have heard you emphasize the importance of contingent capital in the development landscape. Could you expand a bit more on this? And the fact, I've also heard you say this has been somewhat of a slow burn. And what ingredients are necessary to make this shift?
Well, thank you. And it's a real pleasure to be here. I also wear another hat, which is the co-lead for insurance for the UN High-Level Climate Champions as well. So this issue, I think, of insurance and the role of insurance is finally coming to the table. And I'll actually quote someone many people will know, the Managing Director, or CEO of the Climate Policy Initiative, Barbara Buchner, who said that insurers have always had to be in the room, but it's only in the last year or two that they're finally at the table. And so it's nice to be at the table here in this conversation, and also some of my peers as well. Also, I mean, I know this session is around adaptation, but let's be clear, we cannot indefinitely adapt. I mean, I would rather talk about resilience. And resilience, in my mind, is that combination of adaptation and mitigation. We simply cannot have one without the other. So both are critical, and the role of insurance and de-risking, needs to factor in both of those. And actually, I think we need a paradigm shift in the way we think about insurance. Not just the insurance sector, not just those who provide insurance, but those who use and demand the products that our sector provides. So I think we need that paradigm shift in how we think about and use insurance, because the current model of insurance is no longer fit for purpose in a world where we are faced with both physical and economic transition. This model of an annual renewal simply is going to lead to a point, to quote our chief executive at Howden, David Howden, if we continue with this model, we are simply going to renew ourselves into irrelevance as an industry. It is not sustainable. So this paradigm shift is quite critical. And you mentioned contingent capital. I think the other way for those who use insurance to think about insurance is not some very distinct, different sector. I mean, it is, at the end of the day, part of the finance sector. It is contingent capital. It is pools of capital that are there, and they're drawn from the same capital markets as all other capital, which is there when you need it, when a certain set of prescribed circumstances happen. And it is a critical foundation to any capital stack. You cannot mobilize finance, make investments, operate businesses without it, but that seems to have got lost. And we don't have the one thing that surprised me when I've come into the sector, and the team we built at Howden is very multidisciplinary. There's many of us who've come in from other sectors. I've spent 30 plus years in climate and carbon finance. And one of the first questions I asked is, why is there no forward price curve for insurance? We have a forward price curve for every other commodity and service that is business critical, not insurance and not risk. And if we're going to talk about how we use insurance, I think, to understand the risks to assets and infrastructure, we need that forward price curve, because we need that to develop the concept of insurability. So what risks are assets facing over, not just over the next 12 months, but over the longer term? Because we then need to go from that as a building block towards climate-aware underwriting, which at the moment does not exist. And in a sense, that's the paradigm shift that we need, and I think is fundamental. What is the role of public development banks in this? We cannot mobilize, well, we're talking about mitigation, adaptation, climate finance, without insurance. I think of it as yin and yang, or maybe for those of you who are old enough like me and remember Popeye, if finance is Popeye, then insurance is the spinach. And quite frankly, Popeye is not very impressive until he has his spinach, and so we need both, and that has not been happening. That partnership has not been happening in the way it used to happen historically. Public development banks, I think, can play quite a critical role in using those same tools that they're very good at, concessionary, blended tools, but to the part of finance that is the contingent finance sector, to actually de-risk and bring private sector contingent capital into new risks, new markets at a much faster rate, mobilizing the sort of insurance mechanisms that do exist but are being massively underutilized to address many of the risk hurdles that are now the biggest barrier to the flows of climate finance and mitigation and adaptation finance we need at the speed and scale required. Thank you.
Thank you, Anthony, for those reflections. Sobering, given your comments in terms of the challenge around insurability, the need for deeper collaboration, obviously, between the public development banks and insurers. But I also really appreciate your reference to Popeye, because it's a very vivid imagery in terms of the opportunity that perhaps exists in front of us. So, Karina, obviously from AXA, and building on what Anthony has said, how can insurers and public development banks work together to make some of these solutions more accessible, or perhaps even stepping back, addressing some of the structural issues that Anthony had alluded to? And that's also balanced with some of the concerns that we see coming from many of the governments when we engage around this topic of insurance, around affordability. How do you see it? from access perspective, working with many developing countries around this agenda. And in addition to that, can you also offer some very tangible examples in terms of insurance mechanisms and how they're being used to protect critical public infrastructure from climate shocks, and how that is also being used to attract private investments in the jurisdictions that you are actively working in?
Sure. So I think in a world where public financing, I think this is a common theme today, is being squeezed from all sides, insurers can help in, I think, 3 key ways. The first is really risk knowledge. Second is insurance capacity. And the third is that investment capital. So based on that, I think there's maybe like 3 key ways that public development banks and insurers can really work together to really maximize resources in this kind of resource-scarce new world we're in. The first is really taking a step back, and this answers a bit to your point, Anthony, on this really key emphasis that needs to be put on adaptation to make things insurable in the long term. Doing value for money assessments or cost-benefit analyses to understand first, before anything's done, how much of the scarce public money should actually be allocated to disaster risk reduction adaptation, as far as it is efficient. And then, as a second step, then assessing what is the most efficient, cost-efficient allocation of financing for that residual risk across reserve funds, budget reallocation, contingent debt, and insurance. So it doesn't make sense to have an enormous reserve fund that's just sitting there waiting for the extreme catastrophe to happen, as well as it doesn't make sense to have insurance that's paying out for small losses on a yearly basis. You need to optimize those different tools that you have. So I think the World Bank is working on a lot of these kind of analyses before they allocate funding. We're working with them in South Africa, and I think it's a really key thing that should be done before resources are allocated. The second is really on leveraging insurers to set up these climate insurance programs for critical infrastructure, but equally for disaster response. There's other applications as well. And insurers can help on a number of ways. So they can help to develop these public asset databases to figure out what exactly is the key information that you need. So how much does it cost to replace the asset after disasters occurred, replacement value, but also how much it costs to build it back better. Who owns the asset? Who's responsible for the reconstruction? Another way that insurers are helping is to develop these complex risk models, and this is really key. This is where the risk knowledge comes in. And it helps the governments and municipalities to prioritize which are the critical infrastructure that are actually at high risk, which are in the flood zones, which are in the eye of the storm, and try and focus insurance on those and not necessarily insuring everything. The contingency plans is another area where insurers can really help. So putting in building back better clauses for each asset type, clearly indicating which ministry has to do what after disaster, and this speeds up the response. When you've got a clear plan that's pre-agreed, then things happen quickly after a disaster, and that will reduce the cost. So again, maximizing scarce resources. And the last is on parametric insurance. So this is using climate data-triggered payouts that are automatic. You can have very, very quick payouts, and that again will help to reduce the cost because of that speed. And on the PDB side, so the public development banks, they're really critical to subsidize the premium, especially in these first years when these climate insurance programs need to show their value. You almost need enough time for an insurance payout to happen and to see the value of the structure in place. They also help in funding all the capacity building for all the different stakeholders that are involved in setting up these climate insurance programs. You've got the government officials, you've got aggregators on the ground, you've got a lot of different people that are involved to keep the structure going. And equally, the public development banks can help in funding the setup of and maintenance of these public asset databases, as well as the risk models, etc., so that they stay relevant and up to date. So I think a key example of this is the German government, which has co-funded with a number of insurers the setup of many successful climate insurance programs already. And the last aspect, I think, is where public development banks and insurers can work together. This has been said a lot today, but blended finance, but 4 concentrated on adaptation. So I think an example of this is the IFC. They've already worked with a number of insurance companies to, and including having first loss guarantees by, I think the first one was CEDA and different development agencies, to crowd in private capital from these insurance companies. I think they were able to leverage up to 9 times their investment in infrastructure in emerging countries. So that's the MCPP platform. And then equally, the Insurance Development Forum has similarly set up a fund where it allows multiple insurers to co-invest with the DFI for that first loss in climate resilient infrastructure. So I think a lot more of that can be seen, and we can do a lot more and scale that up. I don't know if I should go on if it's all the examples. No, okay, I'll hand back to you.
Okay, thank you, Karina. I think you've given us a wide array of examples in terms of how insurance capabilities can be leveraged in terms of addressing some of the needs that we are seeing emerging in developing countries. I would now like to turn to Madeline, obviously offering a slightly different perspective, representing Climate First RAND. What are the key barriers that you're seeing to integrating climate risk management into infrastructure projects? And how can we overcome them to create a more enabling environment? And it would also be good to get perhaps your reflections on some of the statements made by the other speakers in terms of insurance, but from obviously a banking perspective and its relevance in terms of the work that you're leading. Thank you.
Thank you very much. I think I can chat about the barriers, but how we have cleared those barriers and how we overcome them. So one of the issues would be clear environmental and social risk management in any facility that we lend to. So making sure that we do our due diligence up front and getting data and information on the client is really critically important. It is also something that is required by, in our collaboration with development financiers, when they lend money to the commercial banks to further then distribute for projects. And sometimes they are purpose-based for climate outcomes or green finance. So I think the barriers before would have been accessibility of data and getting information about the client. I think we are getting better at it. We now, in this due diligence, have quite a few things that we can use in the process of getting information about the client and making sure that our credit is sound. We are building in climate credit metrics into our credit assessments, not yet doing negative pricing, but not hopefully, I think this will happen in the future. We are definitely positively pricing, but not yet negatively pricing. So we have our own insurance internally, and they insure basically against default risk. So for them, it's also important to make sure that the asset is sound, that it won't become stranded in terms of climate risk, and that transition risk will not so negatively affect the client that the client defaults as a result. And then the other data that we have started gathering, which I've heard some of my colleagues say as well, is areas in high risk situations, so coastal areas, sea level, assets near floodplains, those immediately elevate the interest and the risk assessment and the insurance cost that is attached to it. And we have developed, similar to some of the large banks in Europe, a tool that helps us geographically map our clients and then layer over that information from our science research center in South Africa to tell us what the likelihood and frequency and probability would be of extreme weather events in the future. And that informs our decision about credit as well. And all of this, I think, collectively gives us enough information to make an informed decision and prevent a credit default.
Thank you, Madeline, for your perspectives, which are a slightly different view. Obviously, from a bank's perspective, some of the internal processes that you are building in order to manage some of these risks that we're seeing. I would now like to turn to Paolo Lombardo, as was mentioned earlier, Head of International Cooperation and Development Finance Department at Cassa Depositi e Prestiti. From a public development bank perspective, to effectively tackle what is a multifaceted array of challenges posed by climate change, it's going to be critical to adopt innovative solutions that bolster resilience. And we heard earlier Leslie make a reference to this, and also enhancing adaptation capabilities. What role can public development banks and DFIs play in promoting these solutions, mobilizing capital, facilitating partnerships, and integrating financial and insurance tools? And what do you see as the gaps, and how is CDP working to address them? And can you also give us some very concrete examples of some of the measures that you are taking within your institution?
Sure. Let me start with a very concrete example. Agriculture is one of our priorities, and when we came across a study on the coffee sector a little while ago that basically said the coffee production around the world could be affected massively over the next decade, we started to actually explore the possibility of creating a global fund for coffee. And the first thought was physical resilience. The plants are no longer fit for purpose. So we immediately started to think about how can we address that. And it didn't take long before we realized that the business model, had a flaw in the sense that you can change the plants. But once you actually plant the plants, it takes 3 years, 3 long years of waiting before actually any production takes place. Now you can think of loss of income for the 25 million farmers out there. But what if you're starting, looking at catastrophic events? All those right plants, the right seeds have been planted, and extreme heat or floods takes all of that adaptation investment and puts it down the drain. So it is at that point that we realized that we needed more than spinach, to be honest, and we had to basically develop something hand in hand with an insurance, with the insurance sector. Now, that's easier said than done, because once we actually started to look at it, we realized that there are some interesting and challenging issues. The take-up rate, in particular in the African continent, on insurance is very low. Why is that? 2 main issues, at least that's what we understood so far. A cultural issue. If you look at smallholder farmers, they need to put food on their table, and spending money on insurance is definitely not an easy sell. The second one is, assuming you actually break the cultural barrier, is affordability. So how you actually then manage to push these products actually down the chain. So what we're looking at now is actually integrating financial instruments with insurance instruments. As I said, we're talking to a leading insurer in that respect. Obviously, the solutions are varied. We understand, Leslie alluded earlier to the need of concessional funds, grants. We are envisaging setting aside some grants exactly for that purpose, to subsidize some of the premium, because without that, we may not get the thing off the ground. And by the way, I believe that is money well spent, because if you do not create insurance, you don't have the financial resilience that is needed. So physical resilience must go in hand with financial resilience. And then, of course, a little bit of self-criticism. I think we could probably do better as banks and insurers. I think we could probably be a little bit more innovative. There are interesting solutions out there. Technology is there. If we think about, reducing the size of the insurance cover, you need to exploit better digital solutions. And I think that's something that, we're basically at the very beginning of that exploration. But again, there has to be a change in culture also on the side of the banks and the insurance industry. So This is just one of the examples we're looking at. We think the approach has to be a global approach because you need to diversify the risk. Otherwise, you may have a bad year in Ethiopia on coffee, but hopefully it will be compensated by a good production in Vietnam, another important producer. So a global approach, innovation across the board, and the world of insurance and banks must work closer together. That's what CDP is trying to achieve in the space of one particular crop, which I repeat, involves 25 million shareholder farmers and their families. Imagine the damage. And this is one crop alone. Thank you.
Thank you, Paulo, for that, for your comments. I think they're also, it's a very sobering fact. It also connects, again, I think, to the discussions that we had in the session earlier, which is the focus on the most vulnerable. So if we are talking about meeting the needs of most vulnerable, if you're a public development bank, if you're an insurer that's interested in addressing that as a structural and deep societal issue, then we need to be prepared to do the necessary work in terms of supporting those communities in understanding what are the risks that they face, right? Sometimes what is obvious is not obvious in terms of what farmers need or these communities need. I also completely agree with you in terms of the investments around innovation. It's easy to throw solutions out the door, but these solutions many times might not land for affordability, cultural understanding, a variety of reasons. So really thank you for sharing those insights. So I will say this first panel gave us hopefully, or gave the audience a view when we talk about, insurance or risk management capabilities. There are a broad spectrum in terms of application. There is scope for further leveraging, further collaboration between public development banks, insurers, banks as well, the entire ecosystem, if we really want to make a change, and particularly if we're focused around issues related to climate. So with that, I would like to now perhaps switch a little bit over to the second panel, which we have, again, as I mentioned, quite a great lineup of speakers to help inform this discussion, which is focused on credit default protection and some of the incredible things that many of you across the table are doing. So the speakers are Hope Moreira, who is Managing Director and CEO of ZEPRI, Mr. Mubarak Mukaila, Head of Sustainable Development at BOAD, as well as Hiroshi Matano, Executive Vice President of the Multilateral Investment Guarantee Agency of the World Bank Group. I will also add full disclosure. Hiroshi, it is great to see you here. Thank you for making the time. Hiroshi is the co-chair of the steering committee of the Insurance Development Forum and has really been pushing us and encouraging us to do more in this space. So also thank you for lending your time to the discussions this evening. And so with that, I would turn to Hope to get us going in terms of this conversation. Again, drawing on the earlier comments from Paulo, only 2% of Africa's population is insured. That is the reality. It's also a reality that sits against more developed markets where we talk about insurance penetration rates sometimes of over 40%. So that's the baseline that we're working in most developing countries. How can you see parametric insurance effectively reaching the last mile beneficiaries like smallholder farmers and pastoralists? And can you also share a real world success story? Second question that I also have for you is pre-disaster financing is up to 4 times more cost effective than post-disaster aid. How can we accelerate the adoption of prearranged financing, insurance, the variety of suite of tools that fit within that bucket, both for individuals and large-scale public assets?
Well, thank you, Akosai, and everyone else who's come before me. Indeed, fit for purpose comes to mind when we talk about penetration, insurance penetration in Africa. What we have as the legacy insurance products don't fit the kind of economic structure that Africa has. So one of the examples I usually give is, how many Africans own a car or even, meet a car in their day-to-day work. So motor insurance is not necessarily the most important, but Africa is about agriculture, it's about smallholder farmers, it's about pasturists, and parametric insurance offers us. Is that better? Yeah? Okay, sorry. Yeah, so just going back a little bit, is about finding something that's fit for purpose, that addresses the need on the ground, on the majority of Africans, where is their need, and talking about smallholder farmers and talking about pastoralists and talking about SMEs, right? That is really the structure of the African economies. So yes, lots of smallholder farmers and pastoralists remain underserved and unserved by traditional insurance, and generally all financial services, right? It's not just insurance. Yet they are most vulnerable to climate-related disasters, and we've seen that increase in frequency and severity over the last decade. The reasons around the low penetration is both supply and demand, and some of the things have been talked about: accessibility, culture, affordability, awareness. So parametric insurance comes in and provides rapid and transparent payouts, strengthening the resilience that we are talking about. So why does it work, right? And why maybe wasn't the other insurance working? So unlike traditional indemnity-based insurance, which is costly, which assumes an infrastructure that allows assessment of claims, parametric insurance relies on predefined triggers, rainfall, vegetation, temperature, etc. So this eliminates that costly and lengthy process. And really, at the end of this, it does make a difference between saving people, timely financial assistance after disaster, which can mean the difference between recovering from a shock or falling deeper into poverty, and in some cases, a loss of lives. We have an experience at ZEPRI running the World Bank funded project called DRIVE, De-risking Inclusion and Value Enhancement, in one of the most difficult and climate risk areas, the Horn of Africa. This is a parametric insurance, NDVI, that protects pastoral economies in Kenya, Somalia, Ethiopia, and Djibouti. And by leveraging satellites, so we did talk about technology and digital, these are really the enablers. We're able to assess pasture conditions, so the trigger is the pasture condition. And then payouts are triggered, and the pasturists are able to go and buy fodder. In 3 years, we've been able to mobilize about $250 million of global and regional insurance capital. Pastorists on their own have contributed about $9 million, so that was really an interesting learning, and about $42 million in subsidies. Okay? And we did hear about concession of funding. I think this is very paramount to the success of the resilience we're trying to create. 500,000 policies are in place, 3 million pastorists and their families have been impacted, and 56 of them are women. In addition to the insurance component, we also have a savings component, because at times when there's no trigger, for the milder shocks, there was need for a fast line of response, so there's a layering. And savings bonus of $50 is paid out to a pastorist who opens an account. And so far we've opened about 400,000 mobile accounts. So bringing people that really have not been banked before into the banking sector. The other part that we've done that is very critical, if you think about that area we're thinking, so much more than insurance, it's how you organize them. So we've created over 10,000 productive groups in some areas. And we know that where you have better organization, then you have better uptake. For sustainability though, through a digital platform, we are creating an ecosystem that connects the pastoralists to market. If they are not able to sell their produce, their cows at the right level, if they are not able to access animal health services, if they are not able to access the markets for fodder, then sustainability becomes questionable, especially in a product that is where the subsidy is reducing with the years. We have further introduced riders to deepen protection, such as hospital cash. So the success of DRIVE, which is 200% successful in year 3, is based on a number of things that we've seen. Yes, parametric was very critical. Two, it was a regional pool. It is that pooling the region, and therefore you're able to attract capital. There's better appetite when you do that. You have to leverage technology, and there has to be provision of both private and public participation as well as funding. In addition to Drive, through our subsidiary ECA Africa, we also are impacting smallholder farmers, essentially de-risking them so that they can have access to credit. We say that farmers want credit, but they really need insurance, right? So how do we de-risk them, embed insurance, and we've seen this grow, and so far we've covered about 3 million smallholder farmers, and services around credit scoring, claims monitoring, bundling insurance products with credit inputs, advisory, disease control, and so on and so forth. Yeah, so indeed there are good case studies that we are looking at how to scale them. It does take a lot of technology that needs in terms of this satellite data that we need. We've seen that we need global reinsurers and partners that bring in that capability. We need local insurers and regional reinsurers. We need local governments. So we talk to chiefs and imams and all that. So it is a whole ecosystem approach that really has made this successful. In terms of, could I go to the second question? Yeah. In terms of how do we, yeah, indeed, prearranged financing is more effective and cost efficient. We know that. What is the positives around that? We know it's about, you ensure preparedness. There is a lot of pressure on fiscal, on budgets, on government budgets. So when there is a disaster, it's lengthy, it's fundraising, and usually it comes too late, too little, too late. We've also seen broader impact when we have prearranged financing. We have seen that it promotes financial inclusion. I mean, Drive is one of them, but we've seen examples around the Africa risk capacity and the payments are made at the sovereign level. We've seen the Morocco, sovereign fund pool that's paid out after the earthquake. So it is indeed, there is examples that show that works best. So how do we get to do that better and bigger? Around this room, right? I like the conversation that are happening. I like the platform that IDF has created, whereby you're bringing private sector with the development agencies, with the World Bank and UNDP, but also creating solutions, co-creating solutions that work, right? So the pressure should continue. I know there's pressure on funding, but in terms of at the end of the day creating the impetus, we know that it's getting worse. Climate change is getting worse. Public assets are destroyed every day. Yeah, so we need to come together. We need to make sure that concessional funding is there. We need to make sure that we're doing something that's fit for purpose. Yeah, so at the end of the day, loss and damage fund, where are we on that? Crowding in the private sector to make sure that we have innovative solutions.
All right.
So I think that's a way to accelerate that. Thank you.
Thank you very much, Hope, for those reflections. I think my biggest takeaway is that it's the insights you have shared point to the fact that there are things that can be done. There are programs that are being implemented where insurers working with public development banks, working with others, are creating the systems that are required to support people to better manage risks and essentially grow and live the lives that they want to live. So again, I think you've pointed to innovation, investing in systems, collaboration, etc., which are all key parts of this process. So with that, I think I will turn to Hiroshi now. Hiroshi, from MIGA's perspective, how can guarantees and other de-risking instruments be used to encourage public development banks to lend more for climate resilient projects while also protecting their own balance sheets? Because we've heard a lot from the livelihoods perspective, really to draw on your experience within MIGA in doing this with sovereigns and much more.
Well, Eko Suihi, thank you for the introduction. I'm Hiroshima Taro from MIGA. MIGA is the guarantee/insurance arm of the World Bank Group. Just before I start, I just want to echo what Anthony mentioned. But I do think the insurance industry should have a table of all these discussions. Parametric insurance is a good example, but I do think that the industry brings something unique, something different, and something really urgent that we need to show to the world that we have solutions and have ideas to be shared. One of the jobs at IDF, which I have the privilege to co-chair, by the way, Kosuehi is the Secretary General there, but it's really to promote the good work that the industry, the reinsurance industry has been doing. Compared to the bank industry and others, I really think that there's more work for us to do to promote what we can provide as a solution in this climate crisis. So I just want to echo my colleagues here about the importance of that. Coming back to MIGA, I think what MIGA specifically or the World Bank Group can do when all these public development banks, PDBs, raise capital, we can help them have a larger kind of raise the amount, the larger amount to raise in the market, or a longer tenor, or cheaper interest rate. So by providing our AAA balance sheet behind the fundraising activities for the PDBs, we think that we can help their deployment of climate finance. And for the MDBs in general, having a certain kind of policy goal is important. And addressing the challenges we see especially in Africa, for all the challenges as a result of the climate change, I think it is an important kind of mission that we have. So that's what we're doing. I was Boad was here, I guess, but we recently raised about $600 million from the market using our guarantee, and they're deploying into climate finance. We do a similar activity across the globe currently, but I just want to add why we're able to do that. So about 60 to 7% of our exposure that we underwrite actually reinsures to the reinsurance market. So the members, the IDF members, are mostly the partners, the business partners, the reinsurance partners that we take. So currently we have a base capital of $2 billion US, which and the gross balance sheet is about 34 billion. So it's a 16-time leverage that we have. But in reality, we reinsure about 60 to 7%. So about $20 billion is reinsured to various reinsurance partners. So in that sense, the industry is really helping us do our business. I'm very thankful for that. But at the same time, we're trying to share our knowledge about all the methodologies or data regarding that climate change to the industry. So I think hopefully it's a two-way kind of a dialogue that we're trying to establish. But I do think that the industry, the reinsurance industry, will play a critical role in mitigation, adaptation, and resilience. So I look forward to further deepening the discussion with everyone in the table. Thank you.
Thank you, Hiroshi, for those reflections. I will take the liberty of asking an additional question because I know we've heard earlier today and over the last few years quite a lot of discussions around reform, etc. And I know that there was also a significant ambition in terms of expanding the balance sheet of MIGA to support, precisely this demand that we are seeing. It would be good as much as you can perhaps to share a little bit in terms of that ambition, just as a bit of context, after the discussions that we've heard in terms of the scale of what is required for MIGA to match those ambitions, again, the role that the industry will need to play in helping you to achieve that.
Thank you again for that question. But yes, we do have a very high ambition. Recently, we combined the World Bank Guarantee Program, the IFC Guarantee Program, and the MIGA Guarantee Program into one platform. And still is a relatively small unit within the World Bank Group, but we have all the specialists, guarantee specialists in one roof under my leadership. So we're quite excited that we can go out to the world and provide various solutions using the three kind of programs we have. With IBRD, with IFC, and with MIGA. So the target, a few years ago, a collective kind of annual guarantee volume was about 5 to 6. And now this year probably will hit more than 10 billion, so we're able to double that in about 5 years. What our target is, by 2030, we want to further double it to 20 billion. So it is a very high target, but we see a huge demand from the market in using our various guarantee programs. But again, we do have limited capacity, and one of the ways that we are able to deliver on this commitment is really because we are able to reinsure to the industry. So I just wanted to thank you for that help.
Okay, thank you very much, Hiroshi. So I think, this brings to a bit of a close the second discussion. We heard in the first conversation quite a lot of focus in terms of the resilience adaptation agenda. And I take your point, Anthony, resilience, because we need to tackle both mitigation and adaptation. We heard quite a bit in terms of the focus on lives and livelihoods and reaching the most marginalized, and the fact that you need comprehensive solutions. We need to collaborate across institutions, sectors, in order to deliver appropriate products. We heard about the diversity when we think about the insurance industry and capabilities that are required, the fact that there is more that can be done with and between institutions, and obviously insight into some very practical programs. So I would now like to open the floor for a few minutes for questions from the audience. I hope that you have burning questions to ask. You don't often get these speakers around the table, so please raise your hand if you would like to raise a question to any of the panelists from both the first or the second discussion. This is a very quiet room. So I will therefore pose a question. What do you think are the next steps in terms of accelerating collaboration between the public development banks and insurers? It would be good to, again, because we've talked about, all the different ideas, but what do you think are the most meaningful steps that perhaps can be taken in the short term to really facilitate greater collaboration? Maybe starting with you, Anthony, Hope, and then and Paulo.
I mean, we can talk about it conceptually, but ultimately what matters is to demonstrate that it's doable. One of the things that we did with the high-level champions, working on the 2030 enabling climate insurance breakthrough last year, we worked with many companies in the sector, including companies like AXA, climate. And we produced this report, The Great Enabler, which sets out 11 examples that demonstrate the mechanisms are there. They are just not being used. One of the deliverables for the breakthrough for COP30 in Brazil at the end of this year is to deliver and to showcase a pipeline of projects where we demonstrate projects that otherwise wouldn't have got across the line. We can get them across the line by bringing insurance solutions to bear. And what I would love to do is to work with a whole number, or us, the insurance sector, working alongside the high-level champions, with a whole number of the public development banks to demonstrate that there are many projects using many of the sort of examples and insurance mechanisms in here that already exist. And actually, with some of that slightly higher risk capital, we can actually demonstrate to the world that this works, that we can bring blended concessionary insurance in alongside blended concessionary finance, and we can actually truly create a sustainable financial future where it makes sense to invest in both adaptation and mitigation in, across Africa and other emerging economies, because I think that is what we have to do. We have to demonstrate the reality of this and then raise that capacity and understanding of what the sector can do. So that's what that in a sense is my challenge to the public development or bank sector. Work with us to actually show how we can do this, because the mechanisms exist. We just need the will, and I think collaboration between the public, the private, and the insurance sector, which are all part of finance, to show that this can be done and change create that paradigm shift through action. Thank you.
Thank you, Anthony. Hope?
Right. So I think for me, it's having the public development banks put their muscle, put their convening power, put their balance sheets also to move insurance the way it has done for access to finance, affordable finance, right? Can we scale up the pilots? Can we move from pilots and pilots? I think there's too many pilots. So what are those that we can scale up? Do we have them? They are there, and be able to now create the impact we want. So I think the fact that we are in the room together is really showcasing that it's possible. But action, right? We need to scale up. I think for me, that's maybe the one message I'd move on. From pilot to scale up, that would be my theme.
Thank you, Hope. I see that there was a question in the room, but maybe whilst you make yours, can you please raise your question, and then we'll get back to it.
Thank you very much. Eva Retrinova from the African Climate Foundation. We are ourselves thinking about the role of philanthropy in this space. We are thinking about our own approach, strategy to climate insurance. We are part of a recently established Adaptation Resilience Collaborative with a number of other funders, philanthropic funders, and the strategy also includes climate insurance. So I would love to ask the panel what they think the role of philanthropy should be in this space, and especially around the way to use the kind of funding we have to scale up and to think perhaps beyond just the affordability, the kind of subsidizing premium question, and more broadly, how can we collectively work to address the kind of the scale of resilience challenge that Africa faces. Thank you very much.
It's a very good question. Are there any takers in the room?
Hi. I mean, it's interesting because what led me to the insurance sector was the last initiative I built at the World Economic Forum, which was the Giving to Amplify Earth Action initiative, which was born out of my frustration of trying to raise philanthropy. And when we built that initiative, we realized that what philanthropy is very powerful at doing, and has done for the last 150 years, is it gets the snowball rolling. It quite often does the first piece of action that then leads to the public-private action that you need, and we call that public-private philanthropic partnerships. And we mapped these with McKinsey across the climate and nature space, and we found more than there were a lot of them, hundreds of them, and we found more than 60% of them were trying to do this de-risking of the capital stack, which made me think a lot about insurance. But I think we had the point earlier around the fact that in many places where insurance is really needed, where if major events happen, people lose everything, but they're not used to buying that sort of financial safety net that, say, those of us in OECD countries are, that we need to raise their understanding capacity. So I think that's quite important. And one of the things that Howden did, again working with many other insurers, was we incubated, and it's now a completely standalone foundation, Humanity Insured, and its whole theory of change, was exactly what you were describing, is to subsidize premiums to build that capacity and understanding. So I think that's one option where I think philanthropy can come in. But again, I also think Hope's point was incredibly important, and it's that scaling, because we've got, and again, this report has all the sort of pilots that have been developed. We have to scale those now. We have to turn that into a sausage machine of transactions where we are absolutely scaling the role of insurance. And again, I think philanthropy can play quite a big role in funding the work to do to raise that capacity and understanding. So I think for me, there's a number of places where philanthropy can come in, subsidizing the premiums to raise that understanding and bring the cost down as people get more used to using it, but also I think to raise capacity and understanding out there of what's already available, because there's the insurance industry has most of the solutions. There is just this structural disconnect, I think, between what we think of as finance and the insurance sector, and I think philanthropy actually could play quite a big role in accelerating addressing that structural disconnect.
Perhaps I can also take the liberty as chair to add a little bit to that. I think one of the things that I've observed with some of the programs that we've seen around the world is that philanthropy, or some philanthropies, have actually supported some of the establishment of these programs. And I can think, for example, of the risk pool in Africa, in the Pacific, etc., where foundations would have supported the base work around the risk modeling that was required to actually support, not simply from a transaction perspective, but also support the governments in terms of building understanding of what their droughts, flood, whatever hazard exposures that they're faced with. And in some ways, it's sort of a contribution to a public good, right? So I think that there are a variety of ways, and that is part of why this gathering is important, to explore what are those efficiencies that we can gain through combining different types of financing to support very targeted communities and questions that these communities have. So it's a very valid question. Yes, I see other hands coming up. Yes.
I'm not offering a solution. I want to ask a question. So what I'm hearing is very positive. And the reason I have a question is that our insurance people have been telling us that and showing us articles that insurance is going to be becoming very expensive because it is very hard to insure against losses that happens in the same location over and over again, because you'll have a flood event and 4 months later you have another. So the community hasn't quite recovered yet, and then the other one hits. So I hear the terms uninsurability, and I hear very high price of insurance from reinsurers. But what I'm hearing in the room is quite the opposite. It seems very positive and optimistic. Is that true?
I also think that is an excellent question. I would not say that. I think the tone is the desire or a sense of urgency to do more. I think on the industry side, there is a sense of urgency precisely because of the issues that you have articulated. In many of the countries that we deal with, accessibility and affordability to insurance is an issue, right? And as I referenced earlier, we've talked as the industry has talked for many years around this issue of protection gap, right? But we are now seeing some of these issues emerge in more developed markets. Part of the challenge that you're seeing there is not only driven by climate, but is also driven by the need to be able to price risk effectively. And so this is where a conversation between the public and the private sector becomes important, because insurance is not valuable if you are talking about frequent risks and frequent shocks. So part of, I think, the important work that needs to be done is to look at how can we understand these risks, but also, again, advance greater investments in building resilience to foundationally, or to basically support risk reduction. Because if we do not do that, you will see a continuation of this trend in terms of increasing lack of access to insurance. And if that pertains, we all know what the consequences will be. So I would not necessarily, and it's a very good point that you raise in terms of a sense of positivity, etc., but I think it is more of an urgency in terms of getting practical, in terms of the collaboration that needs to happen between the industry and other parts of not only the financial ecosystem, but also the development finance ecosystem to tackle this issue. So I think that would be, I hope, part of the communication that is coming through. Okay. I see another question in the room. We will take that question.
Is my mic working? Yeah. Oh, it's working too well. But just to build on this discussion, my name is Preet Gowder from Save the Children. Through the course of the conversation, many challenges have been discussed about insurance. I think Mr. Paulo was talking about the cost of acquisition of customers. We were just now talking about recurring events. We were talking about subsidies needed to reduce or to increase affordability. But with all the pilots that were being discussed, would love to hear from AXA, anyone else, whether we have seen whether business cases fundamentally exist to actually show that there will be the possibility of sustainable scale here. So, instead of challenges, have we seen that there are fundamental reasons for insurance companies to make investments in climate resilience? Have there been any examples from what you all have seen?
I mean, I would just make one point, but I'm sure AXA will have a lot of points, is while we're stuck in this 12-month renewal model, there is no real incentive on the insurance industry to incentivize those investments, because it can just assess its risk and set its premium every 12 months. And we've seen what that future can look like, because in California and in Florida, where you have politically appointed or elected insurance commissioners, they put a cap on the premium, so they've probably accelerated what would happen inevitably, where the premium therefore would just go up and up and up. And in a sense, that's what our CEO David Howden means when he says if we just stay with this current model, we will renew ourselves into irrelevance. The alternative is to develop a concept, the opposite of uninsurability, insurability, and that's what I was trying to get across earlier. But that requires quite a systemic shift in the way we do insurance to actually longer term insurance, which in turn requires a big shift in the analytics and starting to work out how do we actually price and assess that risk, particularly around assets, over the next 8 to 10 years at least. And that's easier said than done, but it's something that we've decided we want to try and work out how to do that, and that's why we launched the Resilience Laboratory with Microsoft at New York Climate Week last year. And the idea being, how do you bring together all the data sets, tools like AI, and then take the climate models, and play the climate forward to see what happens. And that's something we're currently doing in a project with the European Investment Bank and the European Commission, where we're looking at, what has been the effect on agriculture over the last decade of increased climate volatility, because the fact that a couple of years ago the drought caused Europe to lose over 100 billion because of the drought has spooked, I think, Europe in terms of the agriculture. And then we're looking at what happens if you then play the climate models forward across the EU27, and what's going to happen to each of those agricultural systems, and how would the state-backed agricultural insurance programs respond. And that's a very interesting piece of work that everyone's eventually going to have to do. But that's the sort of level of analytics that are going to be required, I think, to achieve what you're suggesting. But I'm sure my colleagues have other perspectives as well.
I'll keep it quick, but insurers are already doing a lot of work. I mean, all insurers and reinsurers will have a dedicated team of consultant engineers who go on site and do all the analysis to see what exactly they're underwriting, and then have requirements to say you need to do X, Y, Z before we can even insure you. So I think the most famous is FM Global, a big kind of corporate insurance company in the US, and they have very, very strict requirements of what exactly you need. Sprinklers, otherwise fire risk, etc. We won't insure you, and they have gold standard. So there is entire huge teams already existing that do this work. So essentially you could say that's forcing clients to improve and reduce the risk. But I think the problem is that not everyone can afford what's needed. And that's what I think Ekoswehi was trying to say. We need the public actors, public financing to support all actors, from all levels to be able to do the necessary disaster risk reduction so that they can actually access that insurance. And that's not, unfortunately, something that the insurers can do themselves.
Yes, can you hear me? Yes, another point that I would add, and just building on Karina's reflections, as again, when we think about insurance, and especially in developing countries, we're talking about, as I mentioned earlier, 2 to 3 insurance penetration rates. So that means that even in more, and also in more developed markets, these are companies that are working with huge corporates that advise them in terms of risk reduction. When you think about governments, often there isn't necessarily a point of contact in terms of who is responsible for managing a government's risk. If you talk about climate, tracking it, what are the implications on your assets? What is your implication in terms of your ability to produce, etc.? Who's responsible for then thinking about the overall risk management? How do you procure insurance, etc., to manage that, right? What is the function or the ambition of the insurance industry in relation to supporting maybe your social ambition for people, low-income communities? These are areas that you do need very considered interactions across both public and private in order to structure the appropriate solutions. So that's just an additional reflection that I wanted to add. I'm conscious of time and the promise to keep us to the 7 p.m. as close as possible closing. So I will return to my original question in terms of what do you see as key levers of change that we could undertake in the short to medium term to really advance the collaboration between the insurance community and also public development banks. Over to you, Paulo.
Look, I'll be extremely brief. I think Anthony has said it. We need to be concrete, and there is no better way to be concrete than actually bring a project at COP30. Just one. It doesn't have to be ours. I don't care which one it is. One, because that could be the seed that actually leads, paves the way to something greater. No disrespect, but panels are good. Discussions, technical discussions are fantastic, but the proof is in the pudding. So let's make the pudding, at least one single pudding, and then I'm pretty sure that more will follow. So we're trying to do our bit. Let's see if we succeed. But I think we should invite everyone to be ambitious and just, try it out. The conditions are there. I think the math, anyone who actually looks at the numbers knows that without spinach, that meal is incomplete.
Thank you, Paulo. Karina?
So I think I want to be a little bit more ambitious than Paulo, so I would say maybe a 2-step short term. If we could get IDFC to bring together all the member public development banks to share knowledge with the MDBs on exactly all the initiatives that have been spoken about today. So it's blended finance, insurance, it's a whole range of different instruments and tools that already exist and have proofs of concepts. If we can share that knowledge very quickly and immediately identify replication projects that could be done in those public development banks countries and get those off the ground as soon as possible.
Thank you, Karina. Madeleine?
I like what Anthony said about creating insurability of projects, and so we're looking forward to that in the market because that's where I see our short to medium term risk.
Thank you, Madeleine. Hiroshi?
Well, I just want to mention I've been a lender in the past and I'm currently working for the World Bank Group, but for any kind of investment guarantee program, equity investment we do, we require insurance on the underlying project. So when we talk about the importance of insurance for existing programs all over the world, and I think I speak for the public development banks also, but insurance is a condition. So unless that is delivered, we're not in the future. If projects become uninsurable, it will face us for a very difficult conversation. So I think the urgency of finding a solution, not for the future, but for tomorrow, I guess, is really important. So I just want to put that on the line.
Thank you, Hiroshi. And maybe I will just add an additional comment, which is, part of why we decided to also have this convening jointly with AFD, UNEP FI, was also rooted in a collaboration that we as the IDF have also launched with the partners at AFD to really work with them on what we're calling an integrated disaster risk management alliance that walks with AFD and their clients to really explore what does a comprehensive sort of insurance offering, both in terms of, yes, underwriting capabilities, but also broader risk management capabilities, can be, what can it look like in terms of its structuring to support its clients. And out of that, we are developing a paper with some very clear recommendations in terms of how the industry can work better, what are the opportunities, levers in terms of facilitating greater collaboration with public development banks. So I just wanted to put that in there as a perhaps watch this space moment. There are things happening. There's a need to collate the information in terms of what is occurring, what the opportunities are, but also to socialize them and focus on getting stuff done. So again, just to say the reflections were well understood. And once more to thank each of you as speakers, as attendees, for contributing your thoughts. I think that the reflections that you offered were very much aligned with the three core themes for the Finance in Commons Summit. First, promoting a collective response to global challenges. I think it was clear we need to do more in terms of collaboration, public, private, scaling up finance, sustainable finance. We can't do that if there isn't a deeper engagement with the insurance industry. Strengthening the impact of PDBs. We have an opportunity to do that collectively. So just once again to thank you, all our excellent speakers, for your interventions and your reflections. And we hope that this doesn't stop here, but that we continue this into actual operational programs. So thank you for your time, and it is 7 p.m. sharp.